Hey there, are you thinking about getting a mortgage or maybe refinancing your current mortgage loan? With interest rates at historical lows, now might be the perfect time to start thinking about mortgages. But how do all these different mortgage options work? It can be confusing. In this video, we're going to be breaking down the 5 most common type of mortgages so you have a good understanding of how they all work and what's the best mortgage when it comes to your needs. Hi guys, I'm Chris Petrie from 1AZ Credit Union and MoneyPeach.com, and I show people how to create a budget, how to save more money, and how to pay off debt. But in this video, we're going to be breaking down the conventional mortgage loan, the jumbo mortgage loan, the FHA mortgage, the VA loan, and the USDA loan. So let's jump right in. So a conventional loan is actually the most popular type of loan, and it's backed by Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac, these are not people. These are mortgage companies that guarantee the loan to the lender. So your lender services the loan, creates the loan, but then it actually sells that loan to Fannie Mae or Freddie Mac. And lenders like this. It decreases the risk on the lender. Now, in order for the lender to create a loan so they can sell it to Fannie Mae or Freddie Mac, there has to be some limits, some rules, some guidelines in place. And one of those is the loan amount. So currently in 2021, the conventional loan limit is $548,250. Now in some areas of the country, high cost of living areas, that actually goes all the way up to $822,000. But for this video, we'll say it's $548,250. So if it falls within those limits, it's said to be a conforming loan, and Fannie Mae or Freddie Mac will be purchasing that loan. This is a good thing for the lender. Also, the lender is going to require some guidelines to how much you put down and your credit score. So your credit score has to be 620 or higher, and the minimum down payment has to be at least 3%. Now, if you put less than 20%, so between 3% and 20%, you are going to pay what's called private mortgage insurance. And this is insurance for the lender paid by you in case you were to default on the loan. Now, private mortgage insurance ranges anywhere from $30 to $90 for every $100,000 you borrow. So let's look at a quick example. Let's say you get a loan for $300,000. Therefore, you're going to pay monthly private mortgage insurance anywhere between $90 and $260 per month until that loan reaches 78% loan to value. At 78% loan to value, the lender is required to automatically remove your private mortgage insurance. So with that said, conventional loans are ideal with those with good to above average credit looking to purchase a primary residence, a second home, or an investment property. So let's say you're looking to purchase a house and the loan amount is going to be more than the conforming loan limits I just mentioned earlier. For example, in Scottsdale, Arizona, the current median home price is $626,000, which is already outside of the conforming loan limits. So the next type of loan you could get is called a jumbo mortgage loan, and these are for home buyers looking to get a loan outside of those conforming loan limits. Now, since it's non-conforming, this means that Fannie Mae or Freddie Mac, they're not going to be guaranteeing these loans, which creates a little bit more risk for the lender. A lender might require a minimum credit score of 700 or higher. They also might require cash reserves. Often lenders will want to see 6 months of monthly payments in cash reserves, and you're going to have a high income to purchase a loan using a jumbo mortgage. Jumbo mortgages are ideal for those who are looking to get a mortgage outside of the conforming loan limits. So far we've talked about a conventional loan and a jumbo loan. Now let's start talking about government-backed loans. The first one we're going to be talking about is the FHA loan. You've probably heard of it. The Federal Housing Administration, or FHA, they provide insurance to the lender in case the borrower were to default on the loan. Now, because the FHA is actually going to provide some insurance for the lender is able to loosen some of the restrictions for those looking to get a mortgage. Some of those looser restrictions include a down payment of 3.5% and a minimum credit score of anywhere from 580 or higher. Now, the one big difference with an FHA loan as compared to a conventional loan is the mortgage insurance premium. It's similar to PMI, but it's a little bit different. So the mortgage insurance premium is actually broken down into 2 parts. There's the upfront premium and there's the annual mortgage insurance premium. Now the upfront mortgage insurance premium is going to be 1.75% of the loan amount, and then depending on how much you put down, you're going to pay anywhere from 0.45 to 1.05% in the form of an annual mortgage insurance premium. So let's look at a quick example. Let's say you get an FHA loan for $350,000. So in addition to that 3.5% down, you're going to have a $6,125 upfront mortgage insurance premium. The good news is that's typically not cash out of pocket. That's something that can be rolled into the life of the loan. Then also you're going to have that monthly or the annual mortgage insurance premium paid out monthly of $248 in this situation. Now another big difference between mortgage insurance premium with an FHA loan and PMI with a conventional loan is how long it lasts. Mortgage insurance premium is going to last either 11 years or for the life of the loan, and it all depends on how much you put down. Another difference is going to be the loan limits. If you remember earlier, I talked about a conventional loan with loan limits up to $548,250. Well, this is lower with an FHA loan, and it goes from county to county. For example, here in Phoenix, Arizona, in Maricopa County, an FHA loan limit is $368,000. Now, if you were to go further north into Flagstaff, Arizona, which is in Coconino County, that goes up to almost $390,000. So the loan limits are a little bit different. And lastly, FHA loans can only be used for primary residences. So FHA loans are ideal for first-time home buyers who maybe have no credit or some poor credit history that they're trying to correct. FHA loans are a great option. Now moving on to our next government-backed loan is the VA loan. Now the Department of Veteran Affairs, or the VA, they guarantee a portion of the loan to the lender in case the borrower default. And VA loans are for a certain group of people. They're for U.S. veterans, active duty military personnel, and spouses of surviving veterans. Now what's really great about a VA is there's no down payment, a 0% down payment. There's no private mortgage insurance, there's no mortgage insurance premium, and instead there's a VA funding fee that ranges anywhere from 1.4 to 3.6% of the loan amount. And the VA also has loan limits that are the same for conventional loans. VA loans are ideal for those who are in the military, for veterans who are looking to purchase primary residences only. All right, guys, the last loan we'll be talking about is a USDA loan. Now, USDA loan is a zero down loan with low interest rates designed for people with low income in rural areas of the United States. Now, the USDA actually determines a rural area of the United States by the population size. It can be anywhere from 20,000 to 35,000 people based on the area of the country you're living in. There's also going to be income limits set for the USDA loans. It's 115% of the average median household income in the area you're looking to purchase your home. And instead of mortgage insurance premium or private mortgage insurance, the USDA loan has their own insurance. They have an upfront fee and an annual portion. And you'll see it's a lot less than with PMI or with MIP. The upfront USDA funding fee is 1% of the loan, and the annual fee is set at 0.35%, and it lasts for the life of the loan. So let me give you a quick example. A $200,000 mortgage will have an upfront fee of $2,000 and then a monthly fee of $58 per month. Now, the USDA loan is ideal for those with low to moderate income looking to purchase a home in a rural area of the United States. Alrighty, so now that you know your mortgage options, I encourage you to go sit down with a local mortgage expert in your area. And if you're looking for one, I highly encourage you to go visit my very own credit union, 1AZ Credit Union. We have 20 branches where you can go sit with a professional mortgage expert, or you can visit us online at 1azcu.com. And lastly, thank you guys so much for watching this video, and you found this helpful. Do me a favor, hit the like button, leave a comment, share this with someone else who also is looking to improve their own financial lives. Thank you guys so much for watching. We'll see you guys in the next video.